Welcome back. Well, now let's see what's happening in the commodities market. We have Dumebi Oluwole, analyst, financial derivatives company, join us now to bring us up to speed. Dumebi, great to see you again.
Thank you.
And a lot has happened since the last time we spoke in these markets. We see investors patiently expecting China to potentially ease the COVID-19 restrictions. That's zero COVID policy.
Yes.
That's a big one.
Yes, yes. The markets are expecting that China would, potentially ease its lockdown restrictions. China has had a very stringent lockdown restrictions since COVID resurfaced in the country. We have like top cities in the country like Beijing. They were on really tough lockdown restrictions. People were not able to move around, and that potentially disrupted the global commodities market. And that's because China is a main importer and exporter of several commodities. When it comes to oil, China is the largest importer of crude oil right now. So with the lockdown restrictions from China, that had an impact on oil demand, and that kept prices high. But right now, rather that kept prices low. We had a huge impact on oil prices. So although the fact that supply received some level of pushback from OPEC. We saw that the net effect of that was that oil prices remained within $90 to $95 per barrel. But with China potentially, easing its lockdown restrictions, we're seeing oil prices prop back up around $99 per barrel. Some analysts even are projecting that oil prices could near $200 per barrel, from $150 to $200 per barrel because of this decision by China. But I mean, the markets are still having mixed signals. So we're seeing the expectation is that it would be a gradual thing for China to come back to the market and increase demand. It was going to be gradual, and then we'll see that have a gradual impact on prices. But there are also some, there's another school of thought that believes that China is going to ramp up demand too much, so because of the fact that they were on a long lockdown period, and so they would, there's going to be like a huge influx of demand that would push prices higher.
And obviously, that's not good for the inflation story.
Yes, of course. The energy crisis, like what the world is experiencing today, this is the worst energy crisis in over a decade. So the expectation is that, if China increases demand and oil prices edge higher, oil prices, it's going to potentially have an impact on the energy crisis that the world is currently experiencing today. So countries or regions like Europe that need as much oil as they can get right now because of the fact that they're entering the winter season for heating, this is going to definitely have an impact on them getting as much crude oil as they can. But for oil exporting countries like Saudi Arabia, it would be a good thing for them because they're going to rake in a lot of more money. I mean, Saudi Arabia they're set on course to make the most money they've made in over 5 years. But for a country like Nigeria that is having a huge shock to oil production, we're supposed to be benefiting from oil price, but because our oil production levels are significantly lower than what is supposed to be, we're not generating as much money. We're not generating as much income that we should be generating, especially looking at the current state of the country, with the fact that we need as much forex as we can get to stabilize the naira.
And I'm sure, at the COP27 going on right now, they wouldn't want to hear, much more demand coming from China at this point.
I mean, COP27, yes, we're trying to focus on climate change, but we cannot overrule the fact that fossil fuels are still going to be in demand right now. The transition towards renewable energy, yes, it's a big deal. We're seeing countries, they've come up with a lot of targets. Okay, but by 2023, we're going to stop using fossil fuels. We're going clean by 2024, by 2050. But the truth of the matter is that with this huge setback to the adoption or the adaptation towards renewable energy, with everything that's happening with the energy crisis, fossil fuels are still going to be around for a pretty long time. I mean, we're seeing some countries in Europe going back to the dirtiest fossil fuel, which is coal. So clearly, this was a huge shock to the entire world, and clearly points to the fact that the world is not yet fully ready to completely transition to renewable energy. We're still going to see some talks about it, but as at this moment, fossil fuels are not going anywhere. So yes, I believe that the idea behind the COP27 right now that is happening is just to reinstate and reemphasize the fact that we need to be aware of climate change. We need to be aware of the fact that we need to adopt cleaner sources of energy. But that doesn't completely offset the fact that the world is not fully ready to completely transition to renewable energy and just stop using fossil fuels. I mean, and this energy crisis just, it just exposed all of that. And for especially emerging markets, low to middle income countries like Nigeria, the transition is still going to take a really long time before we completely, move towards renewable energy. But like I said, it's just to reemphasize the fact that there is such a huge thing as climate change that if we're not careful, our continuous use of fossil fuels will just take us, it's just going to aggravate the situation more than what
there's also that chatter about compensating poor countries,
yeah,
to help with the energy transition. That's
yes,
from,
yes,
the richer nations.
Yes, I mean, we're seeing that happen. Nigeria has received some level of support, I think, from the US on this particular issue. The World Bank is saying stuff about it. The IMF is saying stuff about it. The United Nations is saying stuff about it. The AFDB is saying stuff about it. But that doesn't, like I said, it doesn't change the fact that low to middle income countries right now are not ready right now to completely adopt all of this. We're going to start up things.
For that just transition.
For that just, I mean, we're going to see startups, come up to say, I mean, we've seen startups like Daystar, in this region. We're seeing that so many things are happening in the renewable energy space. Shell, the big oil tycoons are acquiring and also merging, partnering with smaller startups in the renewable energy space to make sure that this thing that we're seeing, we're making progress in it. But like I said, it's going to still take some time because these countries are not fully ready to completely transition. We're still having issues with PMS importation. We're still having issues with fuel subsidy. So how much more a complete transition towards cleaner energy sources? We haven't fully,
apocalypse.
Exactly, we haven't fully integrated wind energy here, even though we have some states that we have some states that we could actually do stuff on wind energy here in Nigeria, but the infrastructure has been dilapidated. We're not seeing so much progress there. Then we're looking at LNG. We're still having issues with gas flaring. We're still having issues with gas exploration and then the refining of gas. I mean, for a country that we have enough gas coming out, but the fact that we have to we're still using gas, for our electricity grids and all of that. But I mean, we're producing so much that we have to export to other countries, but yet we're still having issues with our domestic. To tell you that there's a lot of issues in the fossil fuel sector here in Nigeria that still needs to be addressed. We're still having issues. We're still having talks on fuel subsidy. We haven't seen the PIA come fully into maturity here in the country. So there's still a lot of issues to go on, and this is not only happening in Nigeria. Other African countries, especially in sub-Saharan Africa, are facing these issues as well. So it's like it's going to be it's still going to take some time before we see low to middle income countries like Nigeria completely adopt this.
Yes, it looks like it's going to be a long time.
Yes, it is going to take some time.
Yeah, and we're seeing LNG prices, they're up about 12.30%.
Yeah.
What's driving sentiment there?
Yeah, we're entering into the winter season, and so demand from Europe, it's increasing.
Even though we have that issue with Russia turning off the taps.
Exactly, and that's the more reason why this happens. So we're having increased demand meeting lower supply. So the shock of that, the net effect of that is a surge in LNG price, because LNG is mostly used during this winter period for heating. So while demand is increasing, we also know that supply is really thin right now for LNG, and that's keeping prices higher. And the immediate impact of this is, we're going to see higher costs for heating in countries like the UK, Europe, that are going to definitely experience the winter season this period. The US as well. Demand is going to, the price is going to be high. People are going to have to spend a lot more. But I mean, these countries are taking initiatives to help ease the cost pressure on individuals. I mean, the UK is giving somewhat of an energy palliative to households just to, reduce the cost burden right now because everything is really increasing. Then we also look at the fact that how does this impact a country like Nigeria? LNG is still Nigeria's top export commodity, one of Nigeria's top export commodities that's supposed to rake in a lot of revenue. So we expect that this increase in price, Nigeria would be able to take advantage of it to generate some revenue. But that doesn't still negate the fact that the LNG sector, from the gas exploration to the refining, everything is still having a lot of issues here in the country.
Yeah, and we see South Africa's exports of corn expected to fall. We still have, grain issues,
yes.
globally. But hearing this now coming from South Africa this fall doesn't look good.
Yeah, I mean, everybody's going through it. The global economic crunch is really affecting several countries, and developing countries at the worst hit. That doesn't negate the fact that South Africa is definitely putting in effort to ensure that the corn exports, is gonna bring in some revenue for the country. But right now they're having issues with weather that's affecting their corn harvest, and that's definitely affecting their exports. But generally in the grain, the world grain industry,
right.
Yeah, for lack of better words, the world grain industry. What's happening there is that prices were relatively stable. The United Nations Food Price Index, remained relatively flat between September and October at about 136 points. So indicating that prices are, relatively remaining the same. For wheat, although prices are still higher compared to last month, but it's not as high as what we had in March. And that's because the Black Sea Initiative has come in, and that's the agreement between Russia, Turkey, Ukraine, and the United Nations. And the agreement is that they're going to allow Ukraine, supply the world grains, through the Black Sea.
And expiration is close.
Yes, in 2 weeks' time. But I mean, for now, we've seen that initiative did have a positive impact on food prices. We've seen wheat prices, trade lower, corn prices as well. Some oils like rapeseed oil, sunflower oil, we've seen them, come back into the market, and that has helped to taper prices generally. Even the price of cereals are not as high as what they used to be before. And the expectation is that they're already having talks for a renewal. They're already having talks for a renewal, and the expectation is that, Russia doesn't back up, because there was a militant attack on Russia, and it was supposedly from Ukraine, and then Russia suspended, its agreement on this Black Sea Initiative, and that completely affected the arrangement for just a few days. So imagine the shock if this agreement is not, sustained for the nearest term. We all hope that this war comes to an end.
And that's why we see, a country like Egypt, calling for an end to the war.
Yes, because like I said, the war is affecting everybody, but for countries like for developing countries and emerging markets, that they are worst hit because we have more of the poor and vulnerable within these countries. The inflationary pressures are a lot. I remember that the global economy is adopting monetary policy tightening right now. So it's not exactly a friendly move to other countries that normally, when inflationary pressures are this much, when they're having reduced revenue, they run to these big guys to get some money. But right now, the big guys are actually trying to mop up excess liquidity by increasing interest rates, and investors are like, hey, if the UK is doing this, if the US is doing this, their currency, it's a lot better for me to invest in the economy right now. And it's fixed income instruments that are having an increase in interest rates, so they would rather flock they rather flock these advanced economies and pull out funds from emerging markets. And a typical example of what we're seeing right now is what's happening with the NGX. We've seen it, we've seen thin trading happen. We've seen the all-share index decline, and that's just a typical example of what happens when the big guys increase interest rates and inflationary pressures are just so much.
And obviously the central bankers are still looking at more
exactly. The US
rate
Fed is
hikes
extremely
going forward.
aggressive with this. I mean, although Powell did say that the coming interest rates might not be as as aggressive as 75 basis points, but it's definitely going to still continue. And that shows the priority right now of the advanced economies, that they're planning to tame inflation just so that, first of all, the currency doesn't begin to lose so much value, and then people are not interested in holding these currencies. They wouldn't want to move to safe assets like gold. They still want to hold hard currency. And number two, they're trying to do that to also alleviate the current situation of inflation, because inflation erodes purchasing power. The $2,000 that you would have in hand, or normally that would sustain you for your bills, and you still have a little money to probably have some fine dining in the US, but that's not happening right now.
Right.
And they want consumer spending, they want consumers to feel better. They want to alleviate well-being. They want to, they're gunning for an increase in economic development right now. They're pushing for welfare.
Even though they're destroying demand with the rate hikes.
Exactly, but and then we look at here where economic growth is still the core of the issue. We're still looking to expand business. We're still looking rather at the expense of well-being, even though it's not as aggressive as it, but the truth of the matter is that everything that is happening, we're looking at inflation being imported here. We're looking at also other structural factors that are affecting inflation. Consumer demand is low. So everything is, a typical example with the impact of what's happening globally and how it can affect completely, overturn economic happenings or economic activities in a country. Nigeria is the perfect example. And so, like I said, everything is just going to keep, the developing nations are still going to keep struggling. I remember that it's more of a trifecta effect right now, because we had not fully recovered from COVID-19 before the war started, and then now we're having monetary policy tightening, in global economy. So right. Nigeria is losing money. Our currency is falling. The value of our currency is declining.
So much happening. Thank you so much, Azumebi Oluwole, analyst, financial derivatives company. Thank you so much for your insight.
Thank you.